Good morning, and welcome to the De-Risk Global Markets Daily Brief. It's Thursday, November 13th, 2025. For weeks, markets have been navigating a data fog caused by the U.S. government shutdown, allowing a powerful rate cut narrative to take hold. Today, that fog is supposed to lift, but instead it's been replaced by a new kind of haze. We're calling it the Post-Shutdown Reality Check. The government is back online, but the key October CPI report, scheduled for today, is now the market's biggest question mark. Will it be released? And if so, can we even trust the data? This uncertainty is injecting a note of caution into the market's recent euphoria. U.S. equity futures are reflecting this hesitation. The S&P 500 is pointing lower by 0.16% to 6,864.75, and Nasdaq futures are off 0.17% to 25,580.25. It seems the bad news is good news trade is pausing as traders confront the risk of no news is bad news. So, Alex, this is a fascinating pivot point. As this data uncertainty took center stage, how did global markets process the shift from pure speculation to a potential and possibly messy reality check?
It's a great question, Sarah, because the global session reveals a clear handoff of sentiment. The optimism from yesterday's session carried through Asia, but the caution you mentioned really began to set in as the European desks opened. Starting in Asia, markets largely extended their rally. Japan's Nikkei 225 pushed higher, closing up 0.52% at 51,281.83. That move keeps it comfortably above its 50-day moving average of 47,176, confirming the bullish trend is still very much in play. Similarly, Hong Kong's Hang Seng rallied a strong 1.1% to close at 27,073.03, also trading significantly above its key 50-day SMA of 26,241. For now, Asia seems content to ride the prevailing tailwind of expected Fed easing, looking past the immediate U.S. data confusion. But moving to Europe, the narrative began to fray. In London, the FTSE 100 consolidated after its recent run. It slipped 0.53% to close at 9,859.18, below its open of 9,911.44. However, because it remains far above its 50-day SMA of 9,472, the underlying trend is still positive. This pause was driven by weak domestic data, with UK Q3 GDP coming in at just 0.1%, fueling bets on a more dovish Bank of England. It was a similar story in Germany, where the DAX eased 0.53% to 24,238.16, while it also held above its 50-day SMA of 23,994. The price action reflects growing concerns about Germany's stagnating economy, which posted 0.0% growth in the third quarter. Europe is no longer just importing U.S. optimism, it's pricing in its own economic reality. Now let's look at the U.S. cross-asset picture, where the core theme is intensifying. The bond market is doubling down on the dovish bet. The 10-year Treasury yield slipped further, falling 1.3% to 4.065%. This suggests bond traders see the data disruption itself as a reason for the Fed to ease. This view is pressuring the U.S. dollar index, which fell to close at 99.31, below its open of 99.52, and critically still under its bearish 200-day moving average. The commodity space tells this story perfectly. Gold, the ultimate rate cut proxy, surged for a fifth straight day. It rallied to close at $4,228 an ounce, trading far above its 50-day SMA of $3,923. This is the market's highest conviction trade right now. In contrast, WTI Crude remains the reality check on economic growth. It held steady to close at $58.80 a barrel, but that's still trapped deep below its 50-day SMA of $61.23, with oversupply fears capping any real advance. Finally, and perhaps most importantly, we're seeing the first flicker of anxiety. The VIX edged up 1.83% to 17.83. It's not panic, but it signals that the market's complacency is fading as it stares into this data vacuum.
That's a fantastic breakdown, Alex. A clear divergence where the core dovish trade in bonds and gold is accelerating, while equity markets are finally hitting the brakes on uncertainty. It perfectly sets the stage for a tense U.S. session. Looking ahead, the entire market is on watch for one thing: the Bureau of Labor Statistics. The October CPI report is officially scheduled for 8:30 a.m. Eastern Time, but the prolonged shutdown has created extreme doubt about its release and its integrity. Any delay, cancellation, or data quality warnings will leave the market flying blind and force traders to rely even more heavily on sentiment and Fed speak. And we have plenty of that on the docket. We'll hear from a slew of Fed officials, including Mary Daly, Neil Kashkari, and Alberto Musalem. In the absence of hard inflation data, their every word will be magnified. Will they offer any clarity on how the FOMC is viewing the economic impact of the shutdown, or will they maintain a cautious, data-dependent stance when the data itself is in question? Beyond that, we'll get initial jobless claims, which now carries extra weight as a more timely health indicator, and a 30-year bond auction this afternoon will test investor appetite for duration at these depressed yields. That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.